for all the gloom and doom, I think, that we talk about here on the show, there does seem to be this bizarre willingness, this bizarre push higher on asset classes anytime there's some sort of break, I guess, in the clouds.
Yeah, sure. So this is the part of the cycle that we sort of consider the pivot party, if you will. There's a sense of relief amongst investors that the Fed is getting closer and closer to the end of its tightening cycle. We saw Powell, of course, coming out a little bit hawkish yesterday, which caused some volatility across markets. But by and large, the bond market has not repriced for the expectations here for the Fed to remain on hold and then start cutting rates in July of 2024. So, whenever there is this sense of relief that the Fed's getting close to being done, typically we do see move higher in risk assets, a lot of relief there. And I think that's really what's been driving markets.
I am curious about, we talk so much about the correlations and the negative correlation, I should say, that we've been seeing lately with treasuries and equities here, but we kind of forget about some of the correlations with other asset classes. And I was taking a look at the strength that we saw this week in the dollar, kind of a rare bout of strength, if you will. I think this is going to be like the strongest week that we've had really since early September here. And I'm wondering if investors should now start to put FX back on their radar.
Yeah, absolutely. We think it makes a lot of sense to be leaning into the U.S. dollar here. It acts as a really nice diversifier when we're seeing weakness across both stocks and bonds. We're also looking at an environment where the U.S. economy, while we do think ultimately it will buckle in the face of the lagged impact of Fed tightening, it is no doubt holding up the best across global economies. And we've certainly seen that as of late in some of the business survey data. And the final kind of element here for the dollar is that it does tend to catch a bid in risk-off environments. So if we do see an environment where global economic data contracts, of course, we've been talking about how that bad news has been good news for the market. But when we do see investors start to react to that, that also typically creates a bid for U.S. dollars. So, we might not see the dollar go up, in this sort of resounding fashion that we saw over certain pockets of last year, but we do think it'll catch a modest bid as we head into next year.
And of course, you can't talk about the rising dollar without looking at commodities that are priced in dollars. How does the recent swings in oil feed into sentiment? You look at WTI, for instance, at $91 a barrel in late September, and since then it's come way down. It's hovering around the $75, $77 a barrel. Has it gone from headwind to tailwind?
Yeah, it's definitely been, Scarlett, kind of part of the recipe that I think has given investors this sigh of relief that we're seeing right now. Again, lower rates, rates coming down. We've seen commodity prices coming down, even in the face of increased geopolitical conflict. We think a lot of the decline in oil prices has really come from a decline in demand. So we often forget there's another side to the equation other than just supply. A few weeks ago, the EIA released a study suggesting that gasoline demand is now at a 22-year low. So we do see consumers starting to do the math on higher borrowing costs and potentially pulling away from those prices at the pump. So I do think, again, that's helped risk sentiment as of now, but we need to look at what it might mean going forward. And I think it's part of the puzzle as it relates to this global economic contraction that we're expecting.
Yeah, not to mention geopolitical headlines as well. Emily, talk a little bit about end-of-year portfolio adjustments that investors might be making or thinking about making, and how that dovetails with what's usually expected to be an end-of-year rally because of seasonal patterns.
Yes, a lot has been made of the Santa Claus rally at the same time that my kids seem to be furiously scribbling away at their Christmas lists. And I think we want to take seasonality with a bit of a grain of salt. I know that I'm a little bit scarred from what happened in the last 2 months of 2018. Investors were expecting this burst higher in risk assets as the midterm elections had concluded. And then, of course, Chair Powell comes out and says they're not even close to being done raising interest rates. And we saw how the market reacted to that. So seasonality can play a little bit of a role, but we think that where we are in the economic cycle and what the Fed does next are going to be the most important components to how stocks react from here. We still like higher quality equities. We're leaning into high quality bonds with a 5-6% income and looking at bonds as having the ability to do more heavy lifting in portfolios as we close out the year.
Do you think that change, that shift, that embrace of bonds that we saw this year, Emily, that is structural and that is lasting, that is going to remain a much larger component of portfolios going forward?
Well, look, I mean, we just asked a lot out of the equity market. I was just looking at earnings growth from 2021 through 2022, and we saw 37% earnings growth, explosive revenue growth from the S&P 500 as that $5 trillion of fiscal stimulus made its way into corporate profits. We also saw significant multiple expansion. We started this recent cycle with the S&P 500 trading at around 22 times forward earnings. So we've pulled forward a lot from equities. Meanwhile, we've gotten just about nothing from bonds. In fact, we're staring down a potential third year in a row for negative returns on the aggregate bond index. That's something we've never seen. So I think looking at that 5-6% income, letting that work in portfolios suggests a modest overweight to fixed income.